Hello, everyone. This is Adeel Rizvi, wherever you are joining from. I welcome you to our webinar tonight with two amazing people, really good experts and really good friends of mine. And before I introduce them to you, I quickly wanted to talk about what we will be focusing today. So today's webinar is focused more around people who are considering or who may be considering to enter into real estate, and they may have bought some properties few years ago, and now they are on the brink of, with all the rising interest rates and all the noise of media around what's happening with the market. Will it go down? Will it go south? Will it sustain or will it grow? So amongst these questions, people who want to make that decision, all we are trying to do is just to educate them and let them know what their options may be. Again, this is by no shape or form any kind of financial advice given out. It's more of a generic discussion just to educate people around what their options are and what they can do. And today I have two experts with me. I have Mr. Sakib Manzoor from Secure Finance, who is all about finance, the finance specialist, be it
Good evening,
mortgage.
everyone.
Good to have you, Sakib, today. And we also have Sakina Zubair, who likes to be called a tax guru.
Hello, everyone.
Welcome, Sakina. So, I would like to start the discussion very quickly and float an idea. And we will also be taking questions as we go along during this discussion. So, the first question I would like to throw is, let's say someone has a property, they're living in Sydney, maybe Melbourne, and they bought their property, let's say 5 years ago. They're living in that property, and now they're considering to enter into the property market. And with all the rising interest rates, Sakib, I don't think it's that much of an easy decision for them, is it?
It definitely is a difficult choice. It depends how you look at it. So if you look at the timing when they would have bought this property, which is 5 years ago, somewhere around 2018, 2019, and we all know that since 2018-19, we had a median increase in prices for close to 40% in Sydney. So if they had bought a property worth $1 million, it should be valued close to $1.5 million at this time. So
Yep.
the good news is they have ended up accumulating a lot of equity in their property, which is the first step for someone to start an investment portfolio. But yes, the other side, the flip side of that is that yes, there has been some sharp rate rises in the last 18 months. And for some people, obviously, if the affordability is an issue, then yes, they are doing it tough. But as the way I see it, things is yes, there are challenges, but then there are a lot of opportunities as well.
Yes, you do mention about opportunities, and we do see opportunities coming around in terms of what people can buy. And a lot of times, people don't seem to know about those opportunities because we are more affiliated, or we are more accustomed to the areas we live in. And I made that mistake years and years ago where I wanted to buy my first investment. I already had a home in Sydney, and I said, okay, my first investment should also be in Sydney. So I tried to
Sure.
find something in my backyard, in my neighboring street, and that's where I made a very bad choice. So, Sakina, just to involve you in this discussion as well, you have seen some horror stories going wrong, things going wrong in property, haven't you?
Yeah, well, that's right. A lot of people, they also kind of skeptical to invest in different state purely because they believe that being a landlord owner, they should be able to control the management side of it. To be honest, that's not true. I mean, there are a lot of professionals. You can have your faith on them, and then they will well manage your property. Even though if you've never been there, it will be looked after as you expect.
Exactly, exactly. And let's start from the finance side of it, Sakib. Let's say if someone has, coming back to our scenario where we will be taking questions as well as they come along. But to start with the scenario, let's say if someone already bought a property a few years ago, they have had some good capital growth over there. So where should they start uh, the journey? I mean, people always ask me and say, where should I start looking? Should I look for a property? Should I get a pre-approval? I mean, what should they actually be
Okay.
starting with?
Sure. First, I want to just extend to what you were saying before, in terms of people. We human beings tend to be in our comfort zone, where we tend to do things that we are familiar with. That is why when we are in Sydney, for that matter, or in a certain suburb, so we would like to invest something which is close by. We know the neighborhood, we know the people. We can actually physically go and see the property as well, which may not be the best advice, especially when you're thinking about buying an investment property. And considering the interest rate rises in last couple of years, it's lesser of a choice anyways. But
Yep.
potentially, see, using the same example that we did before, if someone has fortunately accumulated equity and they would want to start an investment portfolio, which is looking to buy their first investment property, it's all good in theory, but you need to go to a finance broker, someone like me first. You need to talk to a mortgage broker to see how much your borrowing capacity is. So we talk about how much you can borrow in terms of buying your next property. We also talk about if this product is going to be suitable to your financial circumstances. We also talk about it if it is going to be something affordable in the near future, or at least from the near future to your midterm future. So we'll talk about all of this. We see if that's what their objectives are, and based on their financial circumstances, if they are able to borrow and what's the maximum they can borrow. Once they have we have determined that, then the next step would be that, okay, with that price range, what are the different suburbs or different states? And then you will start looking in those areas where you need someone like yourself, a buyer's agent. And that's your job, your expertise, to sit down with them and go through, all other factors that I'm hoping that you'll be talking more about.
No, exactly. And I think you made a very valid point as to knowing what your limitations are in terms of finance side of things, how much you can borrow, what is your maximum borrowing capacity. And when you
Yes.
say people need to be able to know what their maximum borrowing capacity is, does that really mean that if their borrowing capacity is 1.5 mil or 1 mil or whatever, should they actually be aiming to buy a property for the same price as well?
I don't think so. So borrowing capacity, in a way, can set a ceiling price for you, but that doesn't mean that you borrow because you can. So because there are other factors that come into play. For example, yes, we look at what your financial objectives are, where you're comfortable with, and then we also would like to bring your accountant into the whole picture, because we would like you to sit down with your accountant to go through the numbers to see if something that we are proposing in terms of your repayments versus rental income, if that is going to be sustainable for you for next 3 to 5 years time. So not necessarily. That is why you need experts like us. So when it comes to the mortgage, the affordability side or the borrowing side, someone like me can help you. When it comes to a tax, strategies, or how it's going to help you in towards your financial goal in the mid and long term, an accountant will come into play. When it talks about, okay, where to find and what's the best property to find, a buyer's advantage like yourself can help.
Definitely. And also, I wanted to come to you, Sakina, with when someone has, as Sakib rightly mentioned, that they may have a borrowing capacity of, let's say, 1 million, doesn't necessarily mean that they start looking for property worth 1 million, because that's what a lot of people have in their minds, that higher price property is what will give them maximum gains as well. That's a very big myth that we come across every day. And that's why people are more inclined to buying in Sydney. But actually, when we look at the data, the capital growth is actually even better in some cases if you try to buy in other capital cities like outside of Sydney, which are like Adelaide, Brisbane, and Perth. And they will give you probably more capital growth in smaller budgets as well. But once someone has an idea of their borrowing capacity, and as Sakib mentioned, Sakina, that they come to an accountant, if someone comes to you with knowing that how much they can borrow, and they come down and sit down with you, what should they be expecting at that point? What kind of discussion you will be having with them?
Usually, we only get the clients when they have their finances sorted, or at least the estimated amount that they could borrow. And once they come from someone like yourself, who may help them to target the ideal property that might be appropriate to meet their goals. So then the next stage comes to us. Then they come to us and they're like, okay, this is how much I'm going to borrow. This is what I'm going to buy. And I'm like, okay, so just because you can borrow 1.5 million, and Adil have found you something that's worth 1.5 million. Have you done your projected cash flow? Have you looked at it? Because other than the interest rate, you have to look after yourself for all other expenses, such as your management costs, your strata costs, your I don't know, rates, insurances, your water bill and repair, and XYZ. So have you sorted out all that? And once they tick all those boxes, then ideally, if they have the borrowing capacity, let's just stick with the same example, 1.5 million, and they target a property that's only 750,000. So I would tell them that if you already have the borrowing capacity to borrow up to 1.5 million, how about you engage a deal again for the rest of the amount to be invested in another property, because they can invest in two properties all at the same time as long as they have the whole borrowing capacity. So they can exhaust the whole borrowing capacity in one go, but leaving just a 200 or 300 aside, that will be then just a waste until they can really have a real income growth in their personal life. For example, if currently their wages or disposable income is 150 per year or 200,000, and based on that they can borrow 1.5 million. And if they leave that 200,000 and they don't consume that, then until their real income will increase to 300,000, they will not be able to borrow again. That 200 or 300 will be completely waste until the real income will increase. Um, but majority of the question we receive from the client is basically, how can I split the ownership with my spouse or a partner?
Yep.
Or what would be the right structure? So the next question we ask them, okay, is that going to be investment property for the entire holding period? Because I get a lot of clients that say, Sakina, I'm unmarried, I already have my own house, I've got a 2-bedroom house, now I'm going to buy a 5-bedroom house as an investment property. But subsequently, once I get married and kids, I'm going to move into that house as my main residence. So we ask those sort of questions that how this property in long term will look like. Is that going to be completely investment property, or is it going to be used for a personal use? So we help them with the structure part. We help them with the percentage proportion between the partners. It becomes more important when the partner is not your wife, is your friend or sibling or your, I don't know, colleague or somebody. So that's where we talk about the tax consequences and all that things.
Now, fair enough. And guys, if you have joined us just now, if you're watching us, feel free to post your questions on whichever platform you're watching, whether it's Facebook or LinkedIn. Just post your questions in the comments and we'll try to answer them with our two very respectable guests today who have been very kind enough to find time for us. Sakina touched upon buying a property if you have a loan of, let's say, 1.5, rather going for a smaller valued property. I'll come back to you, Sakib. From a cash flow perspective, what would you generally believe is a better strategy for people? I know it varies from case to case basis, but if someone is, let's say, a borrowing of 1.5 mil and they're looking to buy investment, should they rather be going for one property which is 1.5 mil or two properties worth 750K each, hypothetically?
Sorry, that question is for me or for Sakina?
That's for you, Sakib. So Sakina,
Okay, sure.
from tech side of things, I would like
Yes,
your
yes.
perspective from
Okay.
cash flow side of things.
Sure. See, I believe, so what happens is, the larger the loan amount would be for one investment property, generally speaking, the lower the rental yield is for that property,
That's
which
right.
essentially would affect your borrowing capacity to be able to do anything in the future. However, so the opposite of that is if you end up buying property where the rental yield is higher. So I'll give you an example. So let's say you're looking to buy a property worth $500,000 and the rental yield is around 6 to 7%. Correct? And I believe that is very much achievable nowadays in certain states.
Yep.
So the interest rate, the actual interest rate nowadays for investment property varies around somewhere in mid 6%. So it's from 6.2 to 6.5%. So if the rental yield that you're getting from the same property is around 6%, so technically speaking, you are covering for most of your mortgage repayment with the rental income that you are receiving. So yes, I know that the banks do use benchmark rate, which is slightly higher than the actual rate, but the net effect on your borrowing for the next property would not be more than 20-25%, which essentially means if you're looking to buy a property worth 1.5 million and you can't afford to buy that much, If you can buy one property for that, but if you break them down into 500,000 worth of properties, you probably are able to borrow four properties worth $500,000. So the total loan amount will be almost $2 million
Yeah,
in this case. So not
that's my
only that you are
strategy as
able to
well.
borrow more, but your rental yield is a lot more in aggregate than you would be able to achieve by just one property worth $1.5 million. And I have actually I have seen that. So for example, I live around the Hillside area. So Hillside area, if you're buying something close to $2 million, 1.8 to $2 million, the rental yield is actually around 2%. And that
Yep.
just kills your borrowing capacity. So all you are able to do is maybe buy your owner occupier house and you're done. That's it. You can't borrow anything else. But if you are going away from here to any state or any postcode where you're able to borrow for something $500,000 to buy a property with a 6% or 7% yield, I believe you can continue. You can continue to borrow. Depending on, I'm not saying that you just go on a borrowing spree, but based on the advice that you get first from your buyer's agent in terms of the property, the timing of the market, and your accountant. And if you have a financial advisor, even better. As long as all they are advising that yes, it is affordable and you are on the right track in terms of your financial objectives, then yes, you would be able to continue on this journey of adding more investment properties in a short span of time. I hope
And
I've answered your question.
yeah,
Yeah,
and we
you
can
did.
look
Yes.
at we can look
Please go
at
ahead.
in we can look at in a rental perspective as well. So, for example, if you have borrowing capacity of 1.5 million and split that into half and half, so that means you will be potentially able to buy two-bedroom house. So instead of buying four-bedroom house in a very fancy area and struggle to occupy that because the occupancy rate may be even lower, unless if it's in a very good school area, then yeah, regardless, the occupancy rate will be high. But let's just say
Yes.
it's just a fancy area, not in a good school area, and then your occupancy rate is low, and then you for four-bedroom house you're barely getting, let's just say 4,000 or 4,500, whereas if you have two-bedroom house then you might be getting let's just say 3,000 per month. So even from a rental point of view, your rental yield percentage may be the same, but from a dollar value it will be higher, which means that from a borrowing perspective for the next property you would be able to step in much quicker.
Yep. Okay. Beautiful. Now, I would like to throw another, not a curveball for you guys. You are pretty good. You are experts at what you do, but a very simple scenario where, uh, let's say someone has 150 grand sitting as their savings in their bank account. And I'll start with you, Sakina. Let's say they have 150 grand sitting in their bank account and they also have an equity of around, let's say 100 grand or 130 grand in their current home, and now they want to use that. They're in that dilemma where they want to decide if they use their own cash savings to put down as a deposit for their first investment property, or they take out and refinance that equity which is sitting there in their current owner occupier home where they live in and use it as a deposit. So from tax side of things, what will be the implications of either of them, and what is a better option to take in the longer run, assuming that everything else remains constant?
Very interesting questions, and we get that quite a lot. So, say for if I have 150 in my pocket, but I also have the ability to pull 150 from my owner occupied. If it's a mutual exclusive decision, then I would definitely prefer to pull the equity, because when I pull the equity, I know it will increase my interest. But from a tax point of view, as long as you can prove or show the next that 150 was not used on your holidays or your fancy lux or a luxury granny flat at the back of
Or
your
attend a wedding, maybe.
home. Yeah, or a wedding. Yeah, as long as it's not spent on all that purposes. If you can prove to the HO that 150, I know will increase your interest rate for your owner occupied, but you can still apportion that percentage, and whatever interest applied to that 150 will be still tax deductible from an investment point of view. But the condition is that the duration of pulling that money till you invest into the investment property should not be too long. When I say too long, in the law, there's no specific month or week or anything defined there. But it can be obviously 1 month or 2 months or 3 months, but you have to prove that during all these 3 months, what have you been doing? I have seen some clients, they have pulled the equity 6 months ago, and then they were so close to execute the transaction, but for some reason that didn't happen, and it took them another 3 months, or it took them 6 months, and that can happen for another 3 months as well. As long as you can prove that when you put that money and you still did not use it and it was just sitting in the saving account, and you can, during that time you can't claim the interest, but once that money is invested, you can start claiming the interest. So if it's a mutual exclusive decision, then I would prefer to go and pull the equity and then use that so I can claim the deduction. And once I'm done with that, pulling the equity and then claim the reduction, then I will use my saving after 2 or 3 months and pay off my personal home mortgage. Does that make sense?
Yep.
And then I will lower down my personal mortgage side of it.
That's how you pay your home loan faster.
Yes.
That's how I will pay my home loan faster. Yeah.
See, you need
but
this
then-
accountant on your side. That's what I keep telling people.
Have the right accountant.
Yeah.
But if
Beautiful.
it's not a mutual exclusive, and then you have the ability, plus you've got a cash flow, exhaust your ability first, and whatever the short flow you have, then use your personal cash flow, and then wait for at least a month or two, and then pay off your personal mortgage, not the loan part, the personal mortgage part.
Yep, beautiful.
Yeah.
Sakib, same question for you as well. So if someone has 150 grand sitting as cash savings in their bank account, plus they can also withdraw equity from their home of around 150 grand, what should they really go for in terms of loan perspective, and also assuming that they have to buy more properties down the line? What is beneficial?
Sure. See, I think the tech side of the things, Sakina has already explained really well. So there's nothing more for me to add to that. The only added perspective I can give you on this one is, so if you are using your own savings, other than the tax sacrifice, the sacrifice of the money that you are putting in there, your negative. So when you go to a bank and ask them that we want to borrow for an investment property, so apart from seeing that how much income you earn and what your existing financial obligations are and what the rental income for the proposed property will be, there's another factor. That factor is called a negative gearing add back, and generally a formula. So negative gearing, they have in their system inbuilt that the higher the loan amount of the investment side of the loan would be, the more negative gearing add back they will put in, which eventually would increase your borrowing capacity. So if you were going to borrow money from your equity versus using your own money, your negative gearing add back will be slightly higher than the other. So which essentially means it does help you borrow more as well. I'm not saying that it's going to double up your borrowing, but that can easily add another maybe 5 or 10% icing on the cake. And it might get you to get over the line in case you're very close to getting the loan that you're after. So these are little tricks, perfectly legal, but that's where we can suggest something. But we would always tell them that we are not neither a financial advisor nor a tax accountant. We would ask them to seek an advice from their own trusted tax accountant. And if that's something that they are able to do it, we can definitely help with borrow the money that they're after.
Exactly. And that reminds me of so many cases that we also deal with on a day-to-day basis, where when people have more cash remaining with them and they decide to use their equity and refinance it, put a deposit down for their first investment.
Correct.
It makes
And
them.
a small before I forget, just a small thing I want to add is, and that is also where you need a good finance broker on your side, because different lenders have different way to treat that negative gearing add back. So we know which bank gives you more versus the other one. So when we know that you are close enough, but you're not getting there, that we can find a bank for you which has a better formula in terms of getting you slightly more borrowing capacity. So that is why those little things banks will never tell you. Plus, bank would only give you what they can give you. They wouldn't. If you go to CBA, for example, they would only tell you if they can lend you money or not. They can't say, "Oh, sorry, we can't lend you, but NAB can." So, but that's where we come in. We save you the legwork. We will not need to push you around all different lenders. We will sit down with you, go through your financial objectives, check your borrowing capacity, and then we will suggest you the best 2 or 3 alternatives where we maximize your borrowing capacity as per your financial objectives.
Definitely. And I had a question to ask, but we have someone actually post a question. Imtiaz has asked, if someone who hasn't got their first home, so this is a different scenario they are throwing at us, and To be honest, we see that a lot in these cases in Sydney and Melbourne these days. So people haven't bought their first home yet. They are still renting, but they're still making good money. Their household incomes are good. But what should they really be doing? Should they buy their own home first, or should they be going for investment property? So I would start with you, Sake. What is your take on that one?
Okay. The conventional wisdom is that yes, you want to buy your own house first. But in today's market, that may not be a case for everyone. So in case where it's very hard for someone to have their first step in because either they can't borrow $1.5 million because they live in Sydney, or they can't come up with a $200,000, $300,000 worth of savings. So the choice is just keep renting or keep saving up and keep trying to earn more so they can borrow, buy their first home. But the other option is, and I see that a lot happening now, where they say that, okay, I can understand that having your own house, is the best thing that can happen to you. But for me, it probably a dream that might take 5 years to fulfill. But there's another dream that I can start with first, which is buying an investment property in an area where not only I'm able to afford, but it also brings you a better rental yield. Plus, there is also a capital growth happening over there, and there is a trend, possibly, projection-wise and all of that, infrastructure and all that, which obviously you can explain the better, where there is going to be a reasonably significant capital growth. So when you talk to them about the capital growth, minus any first-home buyer incentives that they may have to sacrifice because of this, that they come trumps with maybe opting for a rental property first. So I see that happening a lot more now. If you asked me this question 5 years ago, I would be tilting more towards buying your own home first. But in today's market, I would give it 50-50%. So it either could be a better option for you, depending on if you are able to borrow and if you have enough savings in your account to be able to borrow what you want.
Yep, definitely. And I would just like to add to it, you gave a very well-rounded answer, Sakib. And just to answer that question, we are facing these kind of scenarios quite a lot because typically people who are living in Sydney specifically, they want to buy houses which are worth 1.4, 1.5 mil as a minimum. That's what they like. And they're not even brand new. They're established houses.
That's the median price.
That's the median sitting right now. And if they're borrowing because of the rising interest rates, they can't afford to buy that anymore. They would have afforded to buy it 2 years ago, but not anymore. So they are, should I buy or should I keep renting? As opposed to that, recently, like in the last 6 months specifically, we have had multiple, I think we lost Sakina. Hopefully we can have her back soon. But recently what we have been witnessing, to answer your question, Imtiaz, a lot of people who are having a borrowing and who can afford a property only around 600, 700 grand, something for 600, 700 grand in Sydney will only fetch you probably a unit or a townhouse, an old one.
An older unit,
old one where you don't even want to live, where you don't even
with
want
high
to
strata cost as well.
Exactly, high stratas as well. You don't even like your children going to those schools. So you just have to compromise on a lot of things just to get that initial stamp duty waiver and that first home buyer benefits. Which
there's something else. Sorry, you were saying something.
No, you go ahead.
Yeah, so there's something else that we haven't mentioned, and that is the elephant in the room, and that is the availability of rental properties in Sydney. That is almost impossible at this point. So a lot of people, they, when they have no choice but to either buy something, even if you want to buy or rent a place where you want to, but you can't find it, it's extremely hard. So for them, the only choice is either to go places that they don't want to, invest in, but they have no choice, or they keep renting or at the place where they already are, and then invest in other places, in other states where there are lower median prices, where there are high rental yield.
Exactly, you're right. And that's where, welcome back, Sakina. Good to have you back. So
Sorry,
I'm finished.
The battery just went off.
That's okay. So just to complete my response, so what we have been experiencing, Imtiaz, and for all our viewers as well, people, they are better off, like what we bought for our clients last year for around 600 grand, even 550 grand. Those houses, they were interstate. They were in cities like Brisbane, Adelaide, and now we are starting to buy a lot of stock in Perth as well, because that's where the capital growth now is. In the last 12 to 18 months, or even in the last 24 months, those investment properties have now increased at least by 10-15%, which on a 600 grand purchase, you're talking about capital growth of around 90 grand. So my answer to your question would be, because I will look from property side of things, if if you make a decision today which can help you make that extra 80-90 grand in 1 year or 2 years time, you that is much more than what you can save now in trying to buy a unit or a townhouse and and not pay stamp duty for that. Probably you will save 20 grand, 30 grand, but over the next 1 or 2 years you will lose much more money if you try to buy your owner occupier home just because you can't afford to buy a house and your owner occupier is a unit or a townhouse. So I would rather suggest not to go for a townhouse or a unit. If your budget allows for a house, and if that's the area you want to live in, go for it. Go for your owner occupier first. No problem with that. So that will be my response to you in this scenario. Anything you would like to add, Sakina, in this particular question?
Yeah, I when I get a client with that dilemma, I always assist them based on obviously their objectives. That okay, what makes them think that personal home is more critical for them, because that could be something that they're going to get married, or the kids are about school start their school, and that's the specific area they want to step in, and they don't see that their real income will increase anytime soon, and they don't want to exhaust their capacity. If these are the objective, obviously, then the first home should be their personal home, like the first investment should be their main residence. However, I do suggest them that just because the first home is not going to be their main residence, as long as they can buy that house and move in and live in into that house for minimum 6 to 12 months, and then move out from that house and then go and rent wherever they want to rent until they can save good enough money to buy their main house, the agent will still allow them to claim all the deduction for that rental property for the period when they're renting. And then when they sell that property, when they are ready to buy their own house, when they sell that property, the whole capital gain would be tax exempt. It's called 6 years absent rule. So what I'm trying to add here, that if you are in a dilemma where you're not sure whether you should be buying investment home or a personal home, go and buy whichever you can buy at that point in time. As Adeel mentioned, that there's never be at the right time. The time you're ready and you have that money, you just go and buy it immediately, because once you move in and you live in for 6 to 12 months and you move out and go and rent whatever you want, and then you rent out that property, you can still have a rental income, you can still increase your borrowing capacity, and you can still make it tax exempt as well. So you have all that five fingers in the pie.
Yeah.
Beautiful.
And to be honest, not many people know about this rule. So that's
6 years,
why,
yeah.
it's a really good strategy for, again, for some people whom it would suit. So that is why we keep saying this, that you need to come to the experts, because this is what we do day in, day out.
Have a discussion, yeah.
Yeah, exactly. So we can sit down with you, we go through what you're looking to do, and we can suggest you different ways. We've been doing it for years, so if we can make it work for you.
And strategy is the key. And whether your strategy is more tech centric, or you're looking to build a portfolio faster, or you're more comfortable living in your own home and you don't want to worry about finding a rental place every 12 months or 24 months, as Sakib mentioned. So that's where everything comes and has to come together as a puzzle. So it varies from one person to the other, and all we are suggesting over here is more generic. So it may apply to you, it may not apply to you. So that's where we are more than happy to have that separate chat individually to cover your circumstances and your lifestyle.
Sure. So it's just a quick observance, I would say, that we talked about going for a first property or first investment property. What if someone is on to their second or third investment properties? The reason why I want to allude to that is because, remember, you would all remember that whenever the boom starts, you start reading those articles that, oh, this person has 200 properties, this person has 100 properties, and they have accumulated these number of properties in 5 years or 10 years or 15 years time. I can understand my side, because if you, as I mentioned before as well, if you go for a lower median price but with a really, really good rental yield, and over a period of time, 5, 7, 10 years time, that there's a capital growth as well. So those properties are really easy to maintain cash flow wise, and you tend to accumulate also a capital growth over a longer period of time. And once you have a decent equity accumulated in 2, 3, 4 properties, that helps you keep using that equity to keep buying more. Yes. And also from a finance point of view, I can easily see that the borrowing is easier than buying somewhere where the purchase price is much higher. So the borrowing side gets easier as well. And I don't see any problem where why someone would not, if they, they've strategized it well and they've sat down with the experts, why cannot they just continue buying investment properties? So that's my side of it. But I would like to know the Sakina side of it. So if you bring in someone adding a investment property every 6 months, and they end up having 15, 20, 25 properties, should they just continue buying them in their own names, or would that become too complex? Or should they have some special trust or structure set up, which not only helps you with the safety and the protection side of things, but also with regards to the taxation side of things?
Yeah, that comes down to the objective. Again, if they have already invested property A and B and C, and then later they get a wake up call, and I'm like, how I've got all that on my personal name, and now all these property have no more depreciation, have no more negative gearing, and I'm just end up paying more taxes on the taxes I'm paying on my income, and now they've got a wake up call to restructure it. I wouldn't suggest them to restructure their existing property unless if there's some ways I can see that they have got a big room on a super side, and they can make that excess contribution in super side and save on the taxes. So there are some strategies we can help them to park one by one their property from personal name to a trust name. But if they've done only one or two transactions and they're about to enter into a third transaction and they come to us, we always suggest them that if that third property for the entire holding period is going to be known as an investment property, then definitely all the property on a personal name can be just end up into a nightmare, because eventually obviously your marginal tax rate will be keep on growing as you will continue working. As you become more and more experienced, your income will continue growing, which means that your property will be giving you more and more positive cash flow, and your higher marginal rate will cause more taxes on those positive gain income. So it's not really ideal to have all the properties on your personal name. It's always good to diversify a little bit of to invest in the SMSF, a little bit through the trust, a little bit on your personal name. So you need to consider the risk side of it as you move from 2 to 3 to a fourth or fifth property. So structuring definitely need to be considered as you become more sophisticated investor.
I think I would like to just add one more thing over here that we witness quite a lot, Sakina, and you would have witnessed that as well. When people try to go to 3, 4, 5 investment properties, one thing that they need to be careful about is avoiding land tax as well. And if you start buying a lot of stock, a lot of properties in a particular state, you are liable to land tax implications quite sooner rather than later, because that is directly dependent on the land value. And that is where, if the ownership is under your personal name, you may be liable for land tax much sooner rather than having those properties bought under different trust structures as well. So I think that is another benefit that I see for having trust structures for people who want to buy 3, 5, 7 investment properties.
Yeah. Well, look, land tax at this point in time is not a federal tax. It's a state tax. So it's managed by the state. But if you could just recall, a couple of months ago, there was a bit of a joke going around in Queensland, and they come around and they said, I don't really care if you only have 1 or 2 property in Queensland, but if you have a property in Victoria and New South Wales, I'm still going to tax you in Queensland. And then like the whole state were just going up and down, and they were like, what the hell are you talking about? It's a state tax. It's a state tax. But anyway, what I'm trying to say, the government...
And that got abolished. That got abolished. Just letting everyone know that
yeah,
that is
it
not
got abolished
anymore.
However, as a tax agent, I know there's a lot of lobbying going on, and soon it's going to be a federal tax. Once it becomes a federal tax, do not make a decision not to invest into it just in one state because you think that that's going to cause you a land tax because you've got all your investment in land tax. Because once this becomes a federal tax, then regardless of where your property is, as an Australian, you have an investment in Australia, it doesn't really matter what state it is, you as an individual will be paying to the federal government, not to the state government.
And what
I don't
would it really help over there?
don't think we should really make any plan based on this land tax.
Yeah, but
and it's
to
a
be
very
honest,
small tax anyway.
correct. But if someone is looking to buy in today's market where still it is allowed, I don't think any law would be in retrospect. So obviously they will give us
That's
enough
right.
time when the law, comes into play. So then obviously, your decisions, your strategies change as the times change. But as it is now, that it's still a reasonable strategy that you can spread out your properties in different states just to stay under the threshold that so you will not avoid, but you would end up paying less of the land tax. And I don't seem to have a problem with the land tax, to be honest. If the capital growth that you're aiming for,
Small amount.
you know, then it's okay. You would still, come out on the right side of it.
Exactly. That's the idea of it. Like capital growth.
True.
If you're
But
paying land tax,
my question to Sakina, having properties in different structures, does that have a separate threshold? Or would, like, for
You
example,
mean
if I have properties, my SMSF, for example.
it would be, because if your property is in SMSF and you're positive geared by 3,000, then your tax rate is only 15%. So you're going to pay tax only on that 3,000 at the rate of 15%. But if you're positive geared and you've got a personal name
Correct.
and you've got
True.
and your marginal rate is 44% or 44.5% or whatever is the highest one,
That is correct.
and then you end up paying then half back to the ATO. But
True.
if it's in a trust and your wife is just sitting home and not doing work, then obviously you can just give the whole 3,000 to your wife and you make
Good
it
on them.
completely tax exempt. And if it's in the company, then you pay only 25%. It depends
True.
on the structure. Yes, to answer your question in short and sweet term, yes, depending on the structure, your tax outcome will vary,
True.
even if the bottom line of 3,000 is the same across
I
all
think
examples.
I think we should, I think we should talk more about the SMSF. But before I do that, what about the land tax threshold? Do we get a separate threshold, or is there a threshold for a property inside super if we are borrowing inside super?
No, the land tax threshold would be the same. No, that would be the same.
Okay, so you, okay, that's fine. That's
Because that's your holding expense. That's your holding expense. So if you have a property in your SMSF and your management percentage is 2% of your total income, then you have to pay 2% of the total income that they're earning for you. So if the 2%, for example, is the land tax, and I'm not saying which state, and that is the right percentage. For example, if 2% is the land tax of X state and you've got a land of X value, then you have to pay 2% of that X value. Then that 15% is just the income tax rate. Land tax will always be the same, regardless whether it's a personal name or is a SMSF. Doesn't matter.
Yeah. Okay. I see a lot, because I am fortunately one of those brokers who has been doing SMSF loans right from my first month since I started almost 10 years ago. And I used to set up SMSF myself. I used to do financial advice back in the day, which I don't do anymore. But not many brokers are aware of that because it's a bit more complex for an average broker. But that being aside, I personally see that is happening a lot more with someone who's got a decent amount of balance in the super. There has been a recent change, as far as I can read, where now up to 6 people, they can pool up the SMSF super funds together to set up an SMSF.
Yeah.
Not saying that you should set up SMSF. Obviously, you need the financial advisor, also an accountant, to sit down and talk about it. But what I see is that buying an investment property under an SMSF structure, that is quite popular at this time. And my layman understanding is that the benefits of the tech side and the capital growth in the longer term, they are phenomenal. I'll leave it at that.
Yeah.
And I probably would want Sakina to talk more on this.
I normally crack a joke with my client, and when they say, "What the hell is SMSF?" I say, "It's a heaven. It's a tax heaven."
Yes.
Because if you buy a property and you hold it until you retire, you pay no taxes at all, neither on the rental income nor on the capital gain. So I mean, what else do you want when you just pay no taxes?
And I guess there's no cap on it either, right?
No. If you had asked me that question at least a few months ago, I would have said no. But if you ask me now, the cap is there, and it's still lobbying and all that. But let's leave that aside. Otherwise, it will complicate.
It's pretty high though, but it's massive.
You can have your SMSF up to 30 million or 100 million or whatever. But how much you can make it tax exempt? The government have just introduced the cap, but the cap is pretty significant. It's like very big. So
which is what I've read. Yes.
Okay.
Yeah.
So I think we are having a very good discussion. Maybe for SMSF, we will probably have another webinar. We will talk specifically for SMSF, but that's a very valid point. Thank you for raising that, Sakib. Just being conscious of the time, and also there are a couple of questions which we have over here. So one is related to SMSF anyway. So we will take that question from Margaret, and that is for you, Sakina, I presume. do you really have to have an SMSF super fund to buy property with your super?
That's right. You have to have a SMSF if you want to own that property under your own SMSF, and eventually you want to, make get the benefit of the all tax incentive that's related to properties. However, there are a lot of retail super and then all other superannuations who do offer you to consider that what proportion of their balance they want to invest into property, but that's called indirect property investment. It doesn't allow you to directly invest into a property. You can't go to Australia Super and say, hey, my neighbor house is available for sale and I can borrow that much through my super. And can I use my super balance and invest into my neighbor house? You can't do that. You can't direct your Australia Super to invest into directly into the property. But indirect investment property is allowed.
Beautiful. And there's another, I have a question around LMI. I quickly wanted to touch base with you guys. What are your thoughts on LMI? Because a lot of people get scared, Sakib, when you talk to them about that they have to pay LMI and they're like, no, I will actually save up to 20% deposit because I don't want to pay any LMI. What are your thoughts on that?
Well, it depends. In some cases, if you are going to buy an owner-occupied house, and if the loan amount is larger or the purchase price is pretty big, the LMI cost could be huge as well. And if they are able to save up 20% in the near future, good on them. That because I've seen LMI cost to be easily $30,000 to $40,000 in those cases. But it when you talk about buying an investment property, then LMI is not as haunting as it would be otherwise. There are a few reasons for that. First is that to buy an investment property, you need to have minimum 10 to 12% deposit anyways. So you're only now missing out the remaining 8 to 10%. And the LMI the lender mortgage insurance, that's what it stands for, first of all. It's called lender mortgage insurance. It's the insurance cost that the lender would pay because you are not able to provide them 20% deposit. So they need to have an insurance on the loan in case something goes bad. Even though that's an insurance, they are insuring their loan amount, the lenders, but they are kind of forcing the borrowers to pay for that cost. It's funny how it works. And they will add that value to your loan account. So in this case, if you have 10 to 12% deposit, the lender mortgage insurance cost will be around 2%. So now 2% cost, in a bigger scheme of things, if you're buying for a property worth, say, $500,000, it would be around $8,000 to $10,000. First of all, this cost will be added to your loan amount, which probably will be for 25 to 30 years, because that's the loan term it would have. So your monthly repayments to pay off that extra portion of $10,000 would be significantly small. So it will not be a big dent on your cash flows. It will not be too painful. Secondly, now the loan amount goes up because of that $8,000 to $10,000 being added to your base loan account. That amount is also tax deductible. So any interest that you will pay on the lender mortgage insurance is also, as per my understanding, and Sakina should confirm that, please, it is also tax deductible. So a portion of that is coming back to you at the end of the financial year as well. So if you are getting, say, 40% back because of your personal income tax bracket, so you are technically getting 40% of the, and if you're negatively gearing, you are getting 40% of that interest portion back. So that's what I would say. If you look at so I'm just finishing, sorry. So if you are going to look at the capital growth side, if you're going to have a 5 to 10% capital growth in a year, the cost for that will be very, very small when you look at the cost and the benefit basis. Sakina.
Yeah. Just a word of caution that LMI is tax deductible, but it's not an immediate deduction. It's a capitalized deduction. So it has to be capitalized over 5 years. So make sure that when you step into an investment property where you are considering to claim the deduction for LMI, to maximize that deduction, you must hold it for minimum 5 years to optimize the whole deduction up until the last dollar value that you've spent on LMI.
Sorry, so can you explain that? When you say if the loan term is 30 years, so that is being capitalized or amortized for 30 years. So that should be okay?
No. So if the LMI is 10,000, although it will be subsidized across the entire period of the loan, so if the loan is for 25 years or 30 years, it will be subsidized across the whole period. However, that 10,000, the accountant will make their own schedule, and they kind of say, okay, how much was your LMI? So they will look at your settlement document, and on the settlement document, they will say how much was the LMI. So they will say, okay, although the loan is say for 750,000 minus 10,000, so 740,000 will be subsidized for the loan purpose, and the interest they can claim on the throughout the life of the interest, so the loan. But that 10,000 they can divide by 5 years, and each year they can claim the deduction in their tax return.
Sure.
So the
the way I
capital amount
see
will
it,
come back to them in 5 years, but the
correct.
interest amount they can claim on the whole 30 years.
So which actually is a better scenario than what I was
Yeah,
explaining. So you are able to claim
yeah,
it within 5 years. You don't have to wait for 30 years.
that's right. The
Okay, even
capital
better.
amount, you get it back.
Even better.
And the loan will be for the whole that 25 years and 30 years.
Obviously.
So,
Okay.
so
Yeah.
essentially, we
But when
can
they
say,
switch the accountant, make sure they continue with all their schedules to the new accountant as well, and give all that information. Because I got a lot of clients that they said they've got a whole property, and I asked them how much was the LMI last year claimed. I'm sorry, what? And I'm like, how much is your LMI? So some tells me that they've claimed the whole amount. I'm like, what nightmare? You're not supposed to claim the whole amount. I mean, some accountants go and claim the whole in 1 year, which is completely wrong.
Yeah.
Because if you get audited, you will have to pay that back. But I get some clients when they tell me that they don't even know what LMI deduction is, and then I have to reset all their previous tax return and claim that back, and then in the current year as well. So
Sure.
either way, you must make sure that you capitalize in the 5 year. Neither claim it immediately nor completely ignore it.
so
Beautiful.
essentially, you want to add something, Sakib?
Yes, sorry. Yeah, just continuing with what she was saying, and I would want her to give me a similar understanding afterwards as well. So if you have enough equity in an existing property, let's say on owner-occupier property, that allows you to not only be able to borrow to purchase the property 100%, it can allow you to actually borrow more than that. And in most cases, bank can allow you easily up to 105 to 110% of the purchase price of the investment property. That should easily cover you to pay for the stamp duty, any conveyancing costs, any other costs related to buying that property. So if you didn't have equity, you probably will be using your own hard-earned money, to chip in towards all those costs. And because they are your savings, you would not be able to even claim them in the tax. But from the equity, if you're doing it, then you should be able to claim interest on almost anything that you are able to spend, in a transaction of buying that investment property. Sakina?
Yeah. But the key is NUX. Make sure that you don't pull that money, go on a holiday, and then
Obviously,
wait to receive your salary and put it back in your saving account. Like, hey, I've got now 8,000 again. Originally, I borrowed that 150, so I made it up again to 150. So do not
Sure.
break that connection. Do not break that connection.
Correct. So that is, yeah, beautiful. That is why whenever we talk, I talk to clients about that. I make sure that I open up separate accounts. So I normally ask them to open up an account for the 80% loan that we are going to get against the new property. Then I want them to open up another loan split for that remaining 20% plus additional to pay towards the stamp duty and everything else. So this way they end up with 2 new loan accounts, and every dollar is easily accounted for. So not because of that. So it's not easy for them to just take money out and use it for something else. Also, this way they will end up having 2 separate statements being issued for individual loan account, and that makes the job easier for the accountants as well later on. Some people would eventually just use one account and just pull all the money out. It's so hard to manually remove all these transactions.
Yeah, that's right. And it just makes a life easy when you have 2 statements with a 2 different amount, and it clearly states which account is paying how much interest, which one is deductible, which one is not deductible.
Correct. And it's easy to actually to scrutinize the use of the money as well, because then you'll be able to find out if the money was used for something other than the investment property purpose.
Correct.
Exactly. Yep. And I think just to summarize our discussion around LMI from where we started, LMI for investment properties, as what I can summarize from this discussion, and also my own experience, LMI is your friend pretty much. It does allow you to enter into the market quickly rather than waiting longer. And if you wait longer to save the money, in most cases, the property prices also move. So the same asset you may be buying much more expensive later on. You may
Correct.
save that 10 grand, as you mentioned, Sakib. It
But
may
by
be
the
just
time
10
you
grand.
catch up on the shortfall, your price going up.
Exactly.
Exactly.
So that's your friend.
Exactly. Yeah. And my last comment on the LMI, there are a lot of a lot of employment types many lenders allow or would
Yeah.
lend to them up to 90% without having to pay lender mortgage insurance. And in some
Yeah.
cases,
I
like for
think nurses
doctors,
are now part of it.
yeah. So for doctors, they can go up to 95% with not having to pay any lender mortgage insurance. So we got accountants, we got physiotherapists, we got nurses, we got financial advisors. So there are a
Teachers.
lot of professionals where we are able to get them. So if so, that is another reason they should talk to us. Because imagine if they go straight to any professional, like say accountant, for example, and they go straight to a bank, and that bank does not have that policy of giving 70, 90% no LMI. So obviously they will ask you to pay and you will end up paying LMI. But if you come to a broker, they will tell you, okay, these are the lenders who would allow you 90% no LMI, and let's go, and see what we can borrow there. So that's why another reason you need to come to someone like us. We do this every day, so we can find you something better.
Exactly. That's why we are having this session today to actually answer the questions that people have, and then I hope they can get some value out of it from today, and they can start preparing, start thinking, because we are coming into a holiday season, and we are
Sure,
going into Christmas, where people will be sitting, relaxing with families, talking to their partners, thinking about the next year ahead. I think that's
true.
when the decisions do happen. Okay, do I need to go into investment or not? What considerations I need to do?
Yes,
So it's not just about trying to understand, find a property quickly on realestate.com and try
true,
to buy it by making an offer. You actually have to have a strategy first. That's where you
true,
need to know what are your tax implications, what are your borrowing implications, and
true.
what kind of asset will actually help you achieve that. So I think that's
Correct.
where it will be a well-rounded strategy.
Correct. I would suggest to people watching that talk to your tax accountant, talk to your finance broker at least few months in advance to you even thinking about what you want to do. Because we can set you on a path, we can set you on a timeline, and that works really well for self-employed people. If they are talking to their accountants before they close their financials, if they tell us that okay, our objective is in next year maybe to buy our first home or something, that's where tax accountant can go to their financials. And then also if a finance broker also comes into picture, then we can sit down and we can have a proper conference together to see how we are able to achieve those financial objectives for them. So please come to us, talk to us, discuss your future plans. They don't have to be plans 5 years from now. Give us 6 months, a year max, and we would be able to put you on the right path where you are able to fulfill your home ownership dreams.
Beautiful, definitely. Any
I
parting thoughts
just
from
want
your
to
side,
add
Sakina?
one. Yeah, I just want to add one funny example. I often get clients where they're done and dusted with their tax return, and later they tell me that they need to use their tax return for property purpose. And please do not do that. And do not even tell me this during doing your tax return, because once it's gone past 30th of June, then I really can only just tell you bad stories. So
Yeah,
if
I
you really have anything in your mind, as Adil have just expressed, that it's going to be a Christmas holiday, if you are in the process of getting something in the coming year, in 6 or 5 months time in the next year, then it's the right time now, not at that fifth month, not when you have that 150 burning in your pocket. You need to plan it well before you reaching that 150 or 120, whatever is required for your investment or a personal home or whatever you're looking to purchase in the coming year. So plan it at least half of a year early before you step into things, because it takes time, because you might go to a broker and the broker may tell you, oh, I'm so sorry, I know you want to buy something for 700,000, but your borrowing capacity is only 650. So obviously then your broker will help you to strategize to fulfill that shortfall. If you go to a deal and you say, this is where I want to buy property, and they're like, well, I'm sorry, you're looking at the wrong area for that sort of budget. If you are looking for that area, that's the right budget for you. If you come to me and I will be telling you the same thing, so everyone will not give you the answer immediately. No one have a magic wizard. We all need to plan it for you. But if someone can do things just like that, then there's probably something you need to smell it first.
Amazing.
very true.
Beautiful. I'm just conscious of the time. Would you like any parting thoughts from your side, Sakib, at this point?
Well, thanks for the opportunity. I really had a blast, and we should have this more often, I would say. And yeah, it was really meaningful. And I hope listeners would get some good nuggets out of this. We are here. You can see our names, you can see our businesses. In case you have any questions, reach out to us. We are happy to talk. We are available for you. Thank you very much for tonight.
Beautiful. And what we will do after the end of the session is that in the comments, we will post the contact details for all
Sure.
three of us. So you can reach out to us directly via email addresses, which we will be posting. So you can reach out to us, share your personal situation. You can reach out to any one of us as well. If you want to
Yes.
talk to Sakib just for mortgage broking, that's fine. You can reach out to him directly. You don't need to be talking to me for that, uh, or whoever it may be for that reason. So reach out, start discussing your scenario in a confidential way, and start taking some action, because you may be thinking something in your mind, but until you talk to a professional, you really don't know whether it will work out or not, or what may be the implications. So that's really important. From this, I will sign off. Thank you very much for the audience for watching. Thank you very much, Sakib and Sakina,
Thank,
for your time.
thank you for the
My
opportunity.
It
pleasure.
was amazing. We will have the next session very soon, maybe in the new year time, but we will be announcing it in the new year once we are back from the holidays. But
No
thank you very
worries.
much,
Thanks a
guys,
lot.
for tuning in.
Well,
Take
Thank you,
care,
have
guys.
a good
everyone.
evening.
Good
See ya.
Bye
evening. Thank
bye.
you. Bye.
Bye.
Bye bye.